is the headline that's garnering all the attention today.
All the evidence shows there's an investment boom going on.
Markets are looking for clues about the health of the job market.
Artificial intelligence absolutely has already been a disrupting force.
People are right to question how much longer this bull market can run.
With stocks rising, fueled by big tech and easing trade tensions.
This week, the Fed voted to lower interest rates another quarter of a point.
Take a look at futures. Now a little bit of a mixed bag. We've actually seen the Dow tick lower.
Oh boy, here we go again.
It's time to tune out the noise and tune into great information with A Steward's View. Expect valuable economic updates, investing techniques, and planning concepts that will move you to be wise and decide wealth. You'll be equipped in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com. Now, here's your host, Aaron Kolkman.
Welcome back. I'm Aaron Kolkman. That's Chaz Louder, and this is The Steward's View. I'm so glad you joined us again. Check out the weekly economic and market roundup later today at astewardsview.com/blog. Our mission here on ASV is to help you cut through the information chaos of the digital era so you can be wise and decide well. That is, we want to bring light to your financial decisions as stewards. This week, we turn to year-end money moves to help strengthen your position. When is a good time to rebalance? In and after a bull market? What about your retirement accounts? Establishing them, funding them, withdrawing from them? What if you're a business owner? What are the options? We'll look at those things. Before we begin, let's take a moment to examine our work in the context of God's word about stewardship. This is the treasure principle. I referenced the concept of this last week, but I'm speaking in terms of what's widely recognized as the treasure principle from Scripture in the Gospel of Matthew, chapter 6, verses 19 to 21. It says, "Do not lay up for yourselves treasures on earth, where moth and rust destroy, and where thieves break in and steal, but lay up for yourselves treasures in heaven, where neither moth nor rust destroys, and where thieves do not break in and steal. For where your treasure is, there your heart will be also." Let's recall the major idea associated with a steward's view, that we are stewards or managers, not the ultimate owner of our financial picture, not the master of our own destiny, as is commonly thought. The dynamic puzzle box that we are handling is only ours for a short time, and our decisions can flow from that owner-manager perspective. So, before we begin into this week's content, let's take a short break. We'll check out our noise segment right after this commercial.
Investors have holdings scattered under multiple logins. Now there's one place to put it all together. Your entire portfolio in one place. Every asset house, every holding, every transaction, every day. It's called Fusion. Fusion means ongoing portfolio aggregation, without a contract and without a hitch. This important tool can put all your investments into a single view with a universal login, provided by Morningstar and sponsored by Fideer Advisors. Fusion gives its users the benefit of a constant monitor and quarterly risk-reward reports on the entire portfolio. So take a break and take advantage of this valuable view. Register now at FideerAdvice.com. Just click Fusion at the top of the page or type in FideerAdvice.com/Fusion. And now back to A Steward's View.
Chaz, what do you have with the noise segment today? I'm sure it's something interesting.
I've got something very interesting. I look forward to hearing what you have to say about it.
Mm-hmm.
Let's go ahead and share the screen, and here it comes. Little 60 Minutes action.
Do you think that we will have a crash? We thought it was a good time to check in with Andrew Ross Sorkin, one of the country's most influential financial reporters. He's just written a book about the market crash a century ago. Are you scared?
I'm anxious that we are at prices that may not feel sustainable. We are either living through some kind of remarkable boom,
or we're reliving
1929.
Do you think that we will have a crash? We thought it was a good time to check in with Andrew.
Okay, so I just repeated it. Aaron, it's very short. Someone has written a book Andrew Ross Sorkin. And I don't know if that name means anything to you. There's so many financial people in the world, but I've heard you say some different information before, but I would wonder about your perspective because people are hearing, oh my goodness, there's a pattern repeating, 1929 again. What say you?
Chaz, I'm all for the idea that history repeats itself because it does, right? When we're talking about investments, when we're talking about the markets, we're talking about the economy, right? The cyclical nature of the economy, and yes, the financial markets. That is absolutely accurate to say these are repeated patterns over and over and over again. Okay. However, when you say crash, and you're right, okay, we can put the word crash on that book or 1929 or whatever we're going to put. We're going to put 2008 on there, right? And we can ask these questions that are, really designed to create opinion or educated opinion about what? About the worst possible scenario. So I guess I would just ask for what is it that is meant by crash, right? When we talk in portfolio management terms about a correction, which I'm expecting, that's a 10% decrease or greater in major stock indexes. When we talk about a bear market, that's a 20% or greater downturn in major stock indexes. All right. So when we look at stocks in general, they are leading indicators of economic activity. So, I'd like to talk more about what we see in the economy in 2026. That's a very interesting conversation to me compared to 2025, 4, and 3. But from just an investment standpoint, and will we have a crash? I don't know what crash means. I can tell you that in 2008, we had a situation where the S&P 500 was off 3 standard deviations from, the mean return of the S&P 500. Okay, that, if you want to call that a crash, I think that's a fair statement. That was a 70-year event, once in a lifetime. And when do you think the previous event like that was? 1929? You bet. So, I'm not of the mindset that, oh my goodness, it's the first or second quarter of 2022. We're in a crash, right? Even 2001 and 2, right? As tough as that was, the dot-com bubble bust and, Enron and WorldCom accounting scandals happened. Is that a crash? Okay. So let's look at history and let's find out. If we're going to say, let's look at history, let's do that and find out that those kind of extreme circumstances are once in a generation, if that, right? So I really don't see anything, do we have some frothy asset prices? You bet. Do we need to moderate those prices? Yep, we do. Might we have a correction? How about a bear market? Don't know. Recession? Mild one, possibly. All right. But to write a book about the Depression or 2008 even and bring it out right now and go, okay, I feel like I'm, am I signing up for a marketing program? Like, where's my metadata right now? You know what I mean? So those are my thoughts. I don't want to put it down too much. I just want to say, let's be careful with that kind of conversation.
So you're saying correction, and just to repeat what you said, that's a 10% correction, not necessarily a bottom fallout collapse.
Yeah. So, correction, I can't imagine not having a correction right now in the next quarter or two. I would have expected one by now, frankly, but that's because there are so many unknowns in regards to like the what appears to be the high prices, but what is a high price in the stock market? It's ratios, right? We've talked about PE ratios a lot in this program, but when you look underneath, it's really we've just overcapitalized something. Right. So for the number of shares outstanding in the Mag 7 plus 3 names, we have these high prices because we have all this capital that went in relative to the earnings that those companies are putting out. Okay. The difference, I've said before, to the dot-com boom This is a tech-driven thing the last 3 years. The difference is that we have profitable firms, historically speaking, that are associated. These are S&P 500 companies, right? They're not startups, right? Chaz's mediaexpertise.com, that no one's heard of, isn't out gathering capital as a giant what if. That was the 2000 and 2001 situation. So I realistically, to say we won't have a bear market, I can't say that. I can say that we had a real bear market in 2022, and that they happen once every 5 years. And then what we really need to do is rebalance as we try to take profits in the new year. And we'll get into that in this program, where we really look at ending a bull market instead of ending a bear market, why we're going to rebalance in January and not December. But I digress. I just want to point out rebalancing is a very good thing. Holding extra cash where new investment is concerned is a very good thing. And just, being patient. I mean, this is a quarter over quarter, year over year effort. And remember, we're shooting for averages. This whole thing is fine, but we're really getting into, a little bit of what's the tactic of the month, right? When we talk about even a book that big, my goodness, I'd like to read it. It looks really good. So
I have a quick question, Aaron.
Yeah.
Is there some sort of frequency in which we see correction, like a cyclical type thing? I mean, I know it's all contextual what the market's doing, but is there like an average, like every 3 years or 4.5 years or something like that? Do you see that?
I'm glad you asked. The correction figures I will get you, and we can bring them back. No, I brought your questions back on future weeks in the past, so let's look at that next week. Bear markets are the ones that I pay the most attention to, and that's why they roll off so easily. So it's on average about one of every 5 years we have a bear market, right? Corrections are much more frequent. It's so it's not it's not something I look at a whole lot. Okay, so if you say, well, stocks have averaged 10, their deviation has been about 15 over the past 100 years in large companies in the U.S. That just means that my actual returns are somewhere between 10 minus 15, 10 plus 15, right? 2/3 of the time. So I've got a negative 5 or a positive 25 as my range of returns. Okay, well, where was I the previous year? If I had let's say I had a 15% return, and this year I have, at -5, I'm still in that range of returns. And, that would be an example of a correction, right? So, where the bear actually hits is, from a return standpoint, is not quite as easy to summarize, but let's just say your return was substantially lower than -5 for the sake of our conversation. And, the recovery from that, how long does that take? That's the whole conversation as well. But the key for longer term investors is, you hear this cliche, well, stay the course. Whenever we get a correction, whenever we get a bear market, these are huge opportunities to not look at the value of current capital, where it's at, what was my decline on current capital, but what rebalancing can I do? What new cash can I bring in? What are the things that I can take advantage of right now while I've got this massive sale in asset prices, right? And that's the long-term capitalist way of building wealth, right? That's the Buffett story, so to speak, right? Or the Benjamin Graham method, if you will. So I'm very aware of the fear factor that's out there right now, but we may wait 3 quarters or 4 for a correction. I don't know. I just know that the longer we wait for one, the nearer it is, and then we get it out of the way. And whether it's an actual bear or not, we come back out on the other side and we keep going.
Awesome, brother. Well, I thought 60 Minutes, that name has been around for a while. They've got some bigwig financial guy. I'm like, let's see what Aaron says about 1929. So I think that's some good clarity.
Maybe we can submit this to their show.
There you go.
Right? I'll leave that to you. Thanks, Chaz. All right, and we're back. So our core content for today, year-end tactical financial planning techniques. I've made a point in this program of talking about what I call real financial planning. Okay, financial planning that is detailed, that is technically sound, that is probably done with credentialed professionals, people who are experienced and have major designations associated with their names. That could be a CPA, could be a CFP, it could be a CFA. I don't mean to leave anybody out. There are plenty of other good financial designations like the CHFC and the PFS, okay? But for today, what I want to do is not focus on what are the letters after your professional's name, but what are the things that can be done at year end. We're sitting here on December 8th, 2025, and we want to, yes, lower our tax burden, yes, strengthen the financial position that we have, and yes, lay up a better year ahead. So those are the goals. Those are the things. Before we kick off into the key points, let me just mention our sponsor, Fadir Advisors, has some really unique options on their website. And that website, Chaz, I know you give, but it's fideradvice.com, Fidere, 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 advice.com, and then /contact. Okay, so you can send a message there. You can upload data there if you have something you want reviewed. But I encourage at least, and this is something that's gotten kind of set aside in a lot of the financial planning content we've gone through this year, and that is that there are some amazing programs that Fadir sponsors, logins specifically. By programs, I mean computer programs, software. It's very expensive, very nice, that you can use without a cost and without any marketing attached. You're welcome to come in, ask for a login, use that contact page, say, hey, I need a financial planning login. Okay, depending on your situation, we'll set you up with what we call WealthMax, WealthMax 1 or WealthMax 2. These are very nice financial planning aggregators, right? They're connecting accounts all over the place. Everything you own, everything you owe, what's coming in, what's going out. Remember the dynamic puzzle box, okay? So we want to paint that picture. Either you do it, we do it with you, or we'll do it for you. Some combination of those things, whatever you like. But go request a free login. That's fideradvice.com /contact. And start to make sense of all this, okay? But here are the bullet points for year end. Number one, max out your retirement accounts. Okay, so know what your tax projection looks like, at least loosely, and then know, like, am I on track for an annual contribution limit, especially in 401ks, right? Do I need those deductions, yes or no? Especially if I do, how much have I deferred, and also what amount of match am I getting, and yes, profit sharing, is that coming? So those are three different ways that I can fund a 401k. If you need help, just ask. The other consideration is the Roth 401k. I mentioned the tax projection. There's a lot that can be done there to say, okay, do I need the deductions with the bracket, with the situation that I have, federal and state? If I don't need the deduction, I may be better off doing a Roth 401k if that's available through my employer. Okay, so there are also, what I call supplemental retirement account options, the traditional and the Roth IRA. These are smaller dollar amounts that can go in, but nice add-ons to the larger plans. Okay, so those contributions can be made before year end, just like salary deferrals going out of your paycheck into a 401k, but they can also be made after the year end, right? And up until the tax deadline. It's just that you want to keep planning for that. Okay, so that's point number one at year end, retirement accounts. Point number two, harvesting tax losses. So I mentioned earlier, Chaz, that this is something at the end of a bull market to be careful with. A lot, it sounds good, and I reference this a lot because I'm doing it a lot, but right now I'm not. Okay, and I say a lot. I mean, I do it as needed, as it's helpful, as it's profitable for client families at Fadir Advisors. All right. But it's not usually profitable when there aren't tax losses to harvest. Number one, okay, their asset prices right now are relatively high across the board, right? To find lost positions is, at least for me and other PMs that I talk to, a very difficult thing to do. All right, but that doesn't mean not to rebalance. That doesn't mean you shouldn't, pull the extra growth out of Fund A and reinvest in Fund B that didn't grow as much because your universal pie chart changed, right? That is a good idea. Okay, well, now I want to do that in January. Why? Because I'm talking about taxable accounts now. We were in retirement accounts a moment ago, so we shifted. I didn't say that. All right, mea culpa. But in the taxable accounts, we want to wait to rebalance at the end of a bull market until the new year. Okay. So assuming there aren't tax losses to harvest, which also is in taxable accounts. Okay. All this stuff now, we're going to continue on taxable accounts for a bit. That just means we want to recognize asset prices are high. We don't need to generate any additional taxes by selling at the end of the year. Chances are you've got some gain already recognized during the year, some dividends already sent out. Okay, and we know, and we've talked about tax planning in this program as to, what are the behaviors of the holdings that I have and those things. That's always regarding taxable accounts. All right. So waiting until after year end to either harvest losses or just rebalance at the end of a bull market. The harvesting of losses, would be done prior to year end, if there are any. I'm suggesting that there probably aren't, or there aren't many. Okay, but with that, then we still want to rebalance. All right, and that is after January 1st. All right. So keeping going then on the list of what to do at year end here, number 3, making charitable contributions. All right, so you can take low basis holdings, and you can contribute those holdings to a donor advised fund or to your favorite charity. Those are great moves to make. Likewise, a similar option, and this is where, if you're asking ChatGPT things about your situation, that's fine. But where that tool and tools like it stop, the AI world stops and advisors pick up, I'm going to try to give you. Okay, I keep trying to say this is what computers can do, and this is what humans can do.
Buddy,
So something.
I just want to let you know, I was looking for a noise segment because there was a guy who said, "Here's what my robot's doing for me," but it was a scam where it said, text the word this or that to get the information. I tried to get it so we could talk about it. I couldn't. It wasn't good enough to bring to you, but people are doing it. They're doing it. So this is timely.
I know. And I do it too. I mean, it helps me be mindful of what are the things that I need to have on my list,
It's
right?
growing.
When I'm serving. Okay.
Yeah.
It's a valuable tool,
Yep.
but it's not a complete thing either.
Mm-mm.
Okay. We think it's complete because we get a nice, long, detailed output, right? But that doesn't make it complete. Okay. For example, qualified charitable distributions from IRAs. Okay, so somebody that's taking distributions from IRAs, Secure Act 1.0, 2.0, for current, people closer to that age. I don't have the ruling in front of me from the IRS and that guidance, but for people who are closer to age 73, I think it's like 70 and older, you're going to be required to take withdrawals by, it's April 1st following the year you turn 73. Okay. And these are called required minimum distributions. Okay. So whether you're taking them or not, but especially if you are, taking a QCD is not akin to making a charitable contribution from a taxable account on a low basis holding. Okay. And there's all kinds of merit in doing that. I want to come back to that. But this is the giant, oh, by the way, the QCD just says, well, I can take up to $100,000 out of my IRA and donate it to a charity. And if I'm distributing on a required basis, if I have my RMD, I'm in that age category, I'm going to meet my RMD doing this. Okay. So let's say, Chaz, you've got $1 million built up. Your RMD is, $5,000 for the year. Okay. I'm not sure that exact math off the top of my head, but 5% is a realistic expectation. It's publication 590 if you want to go and check my my idea here. But you take the $5,000 out, you go, I don't need this $5,000. I'm 75 years old. It's 2025. And I'm just going to, I want this to go to my church. Okay, that's fine. You just met your required minimum distribution for the year. So you won't get a penalty for not having taken your withdrawal. And you made a charitable contribution to your church. Okay, so that's a neat way for people who aren't dealing with taxable accounts, are not, to take a withdrawal from a pre-tax account, the 401k millionaire scenario, okay, and make a charitable contribution. All right. So a combination of things, certainly good. Back to taxable accounts. So there it was. Did you hear that, Chaz?
Mm-hmm.
Okay, there's that thing that ChatGPT just didn't quite get to. But man, what's the tax cost of not taking your RMD? Well, in that example, it was $2,500. Okay, so pretty soon that planning fee you paid or that asset fee you paid is starting to look pretty good. Okay, so then we go back to taxable accounts and we say, all right, this low basis idea for charity, or why is that helpful? Well, two things. One, there is typically a deduction on any contributions made of low basis securities, any basis securities, whatever, it could be a high basis security to the charitable fund or charitable entity that you're giving to. There is also, the reason that low basis securities get talked about is the avoidance of gains tax on the gain, right? So if I have a security that has doubled in price, I'm shifting that security off of my balance sheet, right? It's leaving my puzzle box and it's going to a charity somewhere that is going to handle it. And chances are they're not going to pay anything on the gain either, right? They do receive, incidentally, they receive your basis when you are giving that security. But being a charity, capital gains taxes for charity, I'll have to double check with the accountants, but pretty sure they're not going to pay that gain. So you get a deduction. It's a $100,000 deduction on the $100,000 contribution from the taxable account. Just had a client do this on Friday. It was $103,000. The basis was about half. Okay, so they got the deduction on their taxes for the $103,000, and the gain of roughly $50,000 was erased. So they have a kind of a double benefit there from a tax standpoint. Okay, so whether that made sense or not, it's a huge opportunity. Donor advised funds are a great way. I hear about these a lot, and rightly so. You can check ChatGPT for what is a donor advised fund, Chaz, or Google or somebody, Gemini. I don't care. Pick your favorite AI tool and check them out. I mean, if you need help setting them up, let me know. They are a wonderful, flexible tool. It's kind of a master charitable fund that you set up, and then you write grant requests out of it over time, and you can engage your family in a giving conversation as well as time goes on. It's a really neat tool. So those are some year-end things that I think about as I'm talking through these conversations with clients. We talked about rebalancing. We talked about charitable contributions. We talked about the maybe tax loss harvesting, particularly at the end of a bear market, and then also just generally rebalancing after January 1st. So there's a lot there. For business owners, I want to comment a little bit because this is such an impressive group of people. I've had a number of new business owner clients this year, and I want to say that they can do a lot at year end that others can't. So I want to give a quick list of what that looks like. Accelerating expenses, deferring income, setting up, maybe if there's setup needed, an individual or solo 401k, a simple IRA or SEP IRA. Those accounts have larger deductions for self-employed people than the standard IRA types. So looking at quarterly estimated tax payments, and just generally trying to prevent any penalties that could come. Those are thoughts. As far as deadlines and that, I won't go into all the deadlines, but I will try to post something later today on stewardsview.com. If not, send us an email, ask a question. You can reach us at team@stewardsview.com. That's team@stewardsview.com. For next year, we'll talk more about year-end in 2026 in economic terms, but from a planning standpoint, I do want to encourage our listeners to set savings targets, to talk through with your loved ones and your other decision makers, or maybe just yourself. What about the targets for an emergency fund? What about the targets for a retirement fund? What about the targets for other goals that need to be funded? Okay, so with that, get a second opinion. I mentioned our logins. They're available at fideradvice.com. You can go right there to our sponsor's webpage. And again, that's fideradvice.com. Hit contact at the top. request a free login to one of our WealthMax programs and get going with that. No pressure, just trying to partner. Okay. So you've got, let's see, a custom checklist maybe that you need. Any questions at all, let us know. With that, I don't have a lot else, Chaz. Your thoughts?
You know, brother, I think this has been a great episode. I just want to encourage listeners and viewers, if you have some noise that you're dealing with as you process everything Aaron has said, again, hit that email, team@fideradvice.com.
Great call. So here's my question, Chaz. To our listeners, how will you proceed in the year ahead? Are you going to keep doing the same thing? Are you going to stay with the same professionals? Or does something need to change? What's the cost of not at least considering what needs to change? How will you know? So we've covered a lot of ground. It's been just a joy. This has been awesome. Love being back. Thank you for listening. I hope this has been a blessing to you. Please do share this episode with others. Next week on ASV, we'll move a little bit further into year-end planning and add some things that we didn't get to today. And then pretty soon we'll be looking at an economic recap of the year and a look ahead, even a market outlook. So with that, we invite you to connect with us online anytime at stewardsview.com. From all of us here at ASV, we look forward to connecting with you again soon. Until then, please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidare Advisors or speak with Aaron, visit fidareadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidare Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidare maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions and is for informational purposes only. Fidare and its representatives do not offer tax or legal advice through Fidare. Please consult the appropriate advisor. Fidare Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidare, please visit fidareadvice.com. That's FIDERE advice.com.